Good morning. Welcome to Morning Call. This will be a big morning for the market, all asset classes today, because you can forget your expectations of rate cuts from here on. The RBI just sacrificed the interest of the bond and the stock markets to protect the rupee market. So that was in sum what happened last night. Huge tightening of liquidity should see interest rates go up in the system, bond yields head up. Though it will save the rupee today, it might have deep repercussions for other markets like stocks and bonds. Mithali, hi, good morning.
Hi, good morning. Shivers down every market spine today, and I think talk as well, Udayan, that the next policy meet might actually see a rate hike in order to align things with this move we've got overnight.
You know, we've been talking about this possibility for the last couple of weeks, but people have been in denial that no, how can an interest rate hike happen right now?
Yeah.
But you know, the signs were there. Other peer markets were doing it. Brazil was doing it. Indonesia was doing it. And Brazil does not have any better growth prospects than India at this point. So if they could do it, why couldn't we? So I think today the penny will drop. The denial will be shaken. The RBI has used its judgment and sacrificed, as I said, the interests of the bond and the equity markets for the currency market. Time will tell, because I think it will be a very hotly debated move from the Reserve Bank of India. I think in the least it's contentious. Some people might think it's a policy mistake as well, given the kind of growth dynamics India is dealing with. So the good thing is that the rupee market will be salvaged at least for the next few days. But at what cost is the big question. You know, you've seen the IIP numbers last Friday. We know that we are staring at 5% growth right now. At a time like this, to curb liquidity, to almost force banks to up rates, for us to, for an investment cycle which is completely moribund, for them to deal with the prospect of interest rates going up and what it does to sentiment all around in the system, I think those are big questions. You can say that the RBI's priorities are different, that's a different game, but I think it's very stock negative and fairly bond negative as we look at some kind of saving phase in the rupee.
And within that, I would be very worried about the banks this morning. But before that, a word on how this might impact liquidity flows as well.
You know, that's the million-dollar question, because on one hand, there will be some capital losses for FIs in the bond book right now because bond prices will fall this morning. But what all emerging markets are trying to do, including India now, is to make our country bonds more attractive for FIs in the longer term, which means we need to see some more FI flows in for medium-term investors. That's the game clearly, but in raising interest rates at a time like this. But what it does to the perception of a country where growth is crumbling
exactly
is a difficult call, you know. And also the RBI is keeping an eye on the FI outflow from the bond market, and it's been lulled into complacency, into believing that there is money which cannot go out of the equity market. So I know the experience of last month says that it's bonds which hurt us more than equity outflows. But if people start taking a dim view of India in the light of further tightening of liquidity and interest rates, and they say India will grow at 4% next year, then you could see a big outflow of money from the equity markets, which might more or less or even more than compensate for any inflows which come into the bond market. So it's a judgment call, but as I'm saying that this is a contentious call, because you've just taken a decision with an eye on the rear view mirror that equity outflows does not happen in India. But if suddenly we were to lose $10–20 billion of equity outflows, the kind of damage we could do to the system, to the market, to sentiment, I think could be quite scary. So I hope it works out well. But I think there is at least a one-third possibility that this could end up being termed a policy mistake. And
you know that even in the last month we saw ETF outflows from equities, and these guys move fast. You know, it doesn't take them time to process information. Just a quick word, by the way, on the bond market. Some notes coming in from FIMDA saying, first of all, that the bands have been changed around today. I guess it is to avoid any kind of circuit situation as we saw the last time round, as also warning bond traders that there could be very, very large figures moving around, so there could be mistakes within that. So I think the bond market is extremely nervous about how trade will open up today, and all these markets will see sharp reactions. Bond, equity, rupee, of course.
Yeah, but you know, bond and equity go together this morning, because bond yields heading up and heading in the direction of 8% is something which the market could not have conceived a few weeks back. It was a question of how quickly we go to 7% kind of levels.
Yeah.
It was not even a debate whether rates will be cut. It's just by how much, 50 basis points or 100 basis points. And now we are talking about hardening of interest rates. We are talking about the interest rate, the yield going to close to 8%, which is hugely negative for equities as well. So I fear for equity sentiment right now, you know, because growth numbers are still very terrible, and this will, as you said, will lead to capital losses. I mean, next quarter, what will banks report? Because there will be trading losses now on their books, and PSU banks already have got hammered out of shape. So this is hugely negative bank Nifty, it's hugely negative Nifty, it's hugely negative bond prices, but
also
positive for bond
in
yields.
the system per se, Udayan. I mean, you know, they're not saying it, but I mean, banks aren't exactly going to be very kind or charitable about this. If rates are going up for them, there's going to be a flow through in the system as well.
Well, of course, and you know what basic demand for things are in the economy like. I mean, you know what car sales are like. I mean, this may hit real estate as well in an indirect way, or not such an indirect way. So, you know, it's a difficult call this morning. So the only silver lining is that the rupee probably hardens to 59, 58 half even. But longer term, the rupee will move with how the deficits are moving and how the funding of the deficit is moving. So if over the next few months you have a situation that a lot of FI money comes into the bond market, that may salvage the rupee for some more time in a durable fashion. If in the next few weeks FI outflows start once again because of the India growth scare becoming more paramount, then I think the rupee will weaken once again despite these moves, because funding of the deficit will still remain a big and humongous task to do.
We'll